The general concept of accrual accounting is that economic events are recognized by matching revenues to expenses at the time when the transaction occurs, rather than when payment is made or received. This method allows the current cash inflows or outflows to be combined with future expected cash inflows or outflows to give a more accurate picture of a company's current financial position. Accrual accounting is considered the standard accounting practice for most companies, except for very small businesses and individuals. The IRS, or the Internal Revenue Service, allows qualifying small businesses less than 25 million in annual revenues to choose their preferred method. The accrual method does provide a more accurate picture of the company's current condition, but its relative complexity makes it more expensive to implement. This method arose from the increasing complexity of business transactions and the desire for more accurate financial information. Selling on credits and projects that provide revenue streams over a long period affects a company's financial condition at the time of a transaction. Therefore, it makes sense that such events should also be reflected in the financial statements during the same reporting period that these transactions occur. Under accrual accounting, firms have immediate feedback on their expected cash inflows and outflows, which makes it easier for businesses to manage their current resources and plan for the future. WorldCom CFO fraudulently took billions in operating expenses and spread them out across so-called property accounts, a type of capital expense account. This allowed WorldCom to show the expenses in smaller amounts over a span of years, instead of reporting them immediately to investors. As a result, in 2001, the company inflated revenue by roughly $3 billion and reported a $1.4 billion profit instead of a loss, and had the operating costs been correctly reported, WorldCom would have lost money for the 2001 fiscal year and the first quarter of 2002. And if you're wondering how WorldCom shuffled its books, well, it's all due to the company's CFO Scott Sullivan, when he took billions of dollars in operating expenses and spread them out across so-called property accounts, which is a type of a capital expense account. This allowed WorldCom to show the expenses in smaller amounts over a span of years, instead of reporting them immediately to investors. On June the 25th, after the amount of the illicit entries was confirmed, the board accepted Meyer's resignation and fired Sullivan when he refused to resign. On the same day, WorldCom executives briefed the Securities and Exchange Commission, revealing that it would have to restate its earnings for the next 5 quarters. And later that day, WorldCom publicly admitted that it had overstated its cash flow by over $3.8 billion over the previous 5 quarters. The disclosure came at a particularly bad time for WorldCom. Even before the scandal broke, its credits had been reduced to junk status, and its stock had lost 94% of its value. It had been facing a separate SEC investigation into its accounting that had started earlier in the year, and was laboring under $30 billion in debt. Amid rumors of bankruptcy, WorldCom said it would lay off 17,000 employees. The federal government had already begun an informal inquiry earlier in June, when Vincent, Bufford Yates, and Norman secretly met with the SEC and Justice Department officials. The SEC filed civil fraud charges against WorldCom on June 26, speculating that WorldCom had engaged in a concerted effort to manipulate its earnings in order to meet Wall Street targets and support its stock price. Additionally, it claimed that the scheme had been directed and approved by senior management, thus hinting that executives higher up on the org chart than Sullivan and Myers had known about the scheme. In June 2002, WorldCom confessed to nearly $4 billion in accounting wrongdoings, and on July the 22nd of the same year, the company filed for bankruptcy, one of the biggest in American history. The bankruptcy filing led to an increase of scrutiny for the company's executives and prompted legal investigations into WorldCom CEO Bernard Ebbers and CFO Scott Sullivan. Ebbers was convicted on 9 counts of scrutiny fraud and sentenced to 25 years in jail for his role in the scandal. He was released in December 2019 due to declining health and died on February 2, 2020. For Sullivan, he was charged with 7 counts and sentenced to 5 years after entering a guilty plea. And voila, WorldCom scandal explained. For your daily dose of finance, make sure to subscribe and hit that bell to turn on notifications. Thank you for watching. I'll see you in the next video. Take care.